Ladies and gentlemen, John AG here, and this video is for a very specific group of people. If you hold silver ETFs like SLV or PSLV, if you hold leveraged silver products like AGQ, or if you hold silver miners and mining ETFs, I'm talking directly to you, not to the pure physical stacker, not to the person who just watches from the sidelines. This is your plan now. Because over the last few days, the message in my comments has been crystal clear. A lot of you did not just stack coins and bars. You bought SLV in your brokerage account. You bought PSLV in your retirement account. You went into a GQ for leverage. You bought mining ETFs and individual mining stocks because you wanted to magnify the silver move. Now, when that violent crash hit, many of those positions dropped harder and faster than spot silver itself. Some of you are sitting on big gains that suddenly shrank. Others are staring at red numbers, wondering if you just made a huge mistake. So, in this video, I'm going to do 3 things. First, I'm going to explain in plain language what each of these assets really is. Because if you don't understand what you own, you cannot possibly build a good plan. Second, I'm going to give you a simple framework you can use to decide whether to hold, trim, or exit these positions after a crash like this. Third, I'm going to walk through concrete examples. If you hold SLV, here's your plan. If you hold PSLV, here's your plan. If you hold a GQ, here's your plan. If you hold miners and mining ETFs, here's how I would think about it. I want you to listen all the way to the end, because the most important part is the mindset and risk management section. That is where most people blow up. Not because silver was a bad idea, but because they put the wrong vehicle in the wrong part of their life. And as always, before we go further, a quick disclaimer. I am not your financial advisor. I'm not here to tell you exactly what to buy or sell. I am here to give you a framework as someone who has lived this market for a long time, so you can make your own decisions with clear eyes. Do your own research and talk to a licensed professional if you need personalized advice. Now, let's get into it. First, we have to be very clear about definitions. When I say physical silver, I mean coins and bars in your direct possession are stored with a custodian in a way that you can legally and practically demand delivery. This is your insurance policy. It has no direct counterparty risk as long as you actually own it and can get it. It does not care about margin calls. It does not care what some ETF prospectus says. It just sits there. When I say unleveraged silver ETF, I'm talking about vehicles like SLV, PSLV, and other spot tracking funds. These exist mostly inside brokerage and retirement accounts. They usually aim to track the spot price of silver. Some are physically backed and store silver bars with custodians. Others may use a mix of physical holdings and derivatives. They trade like stocks. You can buy or sell them during market hours with one click, but they are still financial products. They live inside the financial system. They are not the same thing as a 1-ounce coin in your hand. When I say leveraged ETF, I'm talking about products like AGQ, or similar to times or 3 times silver funds. These use derivatives and daily rebalancing to magnify the daily move in silver. If silver goes up 2% in a day, a 2 times leveraged ETF tries to go up around 4% that day. If silver drops 3% in a day, that ETF tries to drop around 6% that day. Over time, volatility and path can make their performance very different from just 2 times silver. They are complex trading tools, not long-term investments. And when I say miners, I mean operating companies that explore for, develop, and produce silver and other metals, as well as mining ETFs that hold baskets of those companies. These are businesses. They have management teams, cost structures, debt, political risk, operational risk. They are linked to silver, but they are not silver. A miner can go bankrupt even if silver goes up. A miner stock can double even if silver just moves sideways. If the company improves its costs or fixes a problem, you're not just betting on the metal. You're betting on management and margins. So, now that we're clear on definitions, let's build a simple plan. I want you to imagine a triangle. At one corner is time horizon. At the second corner is risk capacity. At the third corner is purpose. Time horizon means how long can you leave this position alone without needing the money? Are we talking months, years, or decades. Risk capacity means if this position drops another 20 or 30% on paper, does it actually threaten your financial survival, or is it uncomfortable but manageable? Purpose means why did you buy this instrument in the first place? Was it to hedge against system risks, to get price exposure in a tax-advantaged account, to speculate with leverage, to capture upside in mining equities? If you don't answer those three, no plan will ever feel right. So, I'm going to keep coming back to them. Let's start with unleveraged silver ETFs like SLV, PSLV, and similar funds. If you hold SLV in a regular brokerage account, here is what you effectively own. You have a claim on a fund whose stated goal is to mirror the spot price of silver minus fees and tracking differences. You do not have legal title to a specific bar. You cannot just walk up to the vault and ask for your 5 kilos. You are relying on the fund structure, the custodian, the auditors, the whole legal and operational chain. In exchange, you get high liquidity. You can sell instantly in size. You can put it in tax-advantaged accounts that cannot hold physical coins directly. You can write options on it. You can rebalance it more easily. If you hold PSLV or a similar closed-end or a trust-style fund, your position is closer to a pooled physical vehicle, often with different custody and redemption terms. Some of these funds allow large holders to redeem for physical. If they hold enough units to match large bars, and they can trade at a premium or discount to the net asset value.